to Central Questions. Central Questions is a podcast about finance, what happens in financial markets, what is going on among buyers and sellers, and also what happens when it comes to the global economy, but always from a financial sector perspective in one form or the other. My name is Stefan Ingves. I'm the former governor of the Swedish Central Bank, and I'm presently a senior fellow here at the Swedish House of Finance at the Stockholm School of Economics. Now, today I have the privilege of having Professor Robin Greenwood as a guest, and he comes from Harvard. He is the George Gund Professor of Finance and Banking at Harvard Business School. And you, Professor Greenwood, you have done extensive research when it comes to booms, busts, financial market issues, and part of it is behavioral in the sense that why is it that from time to time, for various reasons, things go wrong, and what can we do about it so that it doesn't go wrong, maybe as often it has done in the past. But before we get into those issues, could you just please give me a few words about your background and also about the research that you have done?
Sure, great to be with you, Stefan. My background, actually European, originally born in Belgium. Mother is Dutch, dad is English, went to the US, and then grew up all over the place before going to MIT and doing a PhD at Harvard in economics. And actually, I got interested in bubbles and instability when I was in graduate school. It was the late 1990s, and I had left college at a time when many of my peers were going to exciting .com companies. And it was pretty tough, I have to say, writing out problem set solutions when you're hearing about all these guys starting companies and in the middle of this enormous boom. So I got very interested in what was going on in financial markets during that time. And actually my first published paper was writing about a set of 30 stocks that were added to the Nikkei index right as the bubble was about to collapse. So literally in March of 2000, they added 30 new economy stocks and kicked out 30 old economy stocks from the index. And it was sort of the beginning of the end. The paper wasn't really about the bubble per se there, but it really got my interest going in these types of things.
I really look forward to this conversation because it just so happened that I came walking down the corridor in the finance ministry in this country when the whole system started falling apart. And then based on that knowledge that we acquired during many late nights and weekends, I ended doing kind of let's put the pieces back together work for many years in many different parts of the world. And then of course to talk to a person who has looked into this and also has spent time on arguing about what to do in order to avoid these things is of course very, very interesting given my background as a practitioner. Now, when it comes to whatever we call them, so I just use the term bubbles, it seems to be a tricky issue in the sense that if you go way back, let's say to the 1800s, we had the railroads, and no one would argue that the railroads were not a good thing. They were, but at the same time, things blew up, and that created pain. Now, earlier we had the dot-com bubble that you referred to, and now there is a lot of conversations going on about investments in AI and all the hardware that you need to have in order to produce AI services. And in addition to that, you have to use up a lot of electricity to make that happen. But can we distinguish between real stuff that is actually of value to mankind and just a bubble which doesn't really produce much of real value because prices just go up and then they just come down and nothing much more happened except that people lost a lot of money?
I'm not sure you have to distinguish between them. I think most bubbles come out of something real. I'd give you another example. You mentioned some very famous ones, but the 1920s, for example, it was the electrification of the United States and starting to be the electrification of the world. And a lot of people think of the 1920s, for example, they say that was railroads. The railroads were, as you said, in the 1800s. And so electrification brought amazing things to consumers and to the country. Kindleberger called this displacement. So the original force driving the bubble is something real. You then typically see it in fundamentals in some form. So either in earnings or certainly you see it in investment plans. And often you see it in heightened competition, and that heightened competition ultimately means that consumers get lower prices and benefit from these periods of increased innovation. And I think the bubble is just, whenever that gets out of hand in valuations, you get excess investment, you get excess issuance, and of course it doesn't always end well for investors. But I don't think that means it's a bad thing. I think it's a bad thing when it's combined with a lot of leverage and you have destruction in the financial sector, and that's really spreads over to banks and so on. But I think at the core of most bubble episodes is something real and something we benefit from.
In the medium to long run.
In the long run. Even the dot-com period, if you look at, we got dot-com, we got the internet, we got lots of cable laid in the United States and globally. Yeah. You know, many of those players went bankrupt, but really, if you fast forward the clock, we needed all that cable, right? In fact, we didn't have enough. So there were these enormous benefits that came despite the, I would call, financial destruction that happened because some of these players were too levered.
But then you're kind of saying that on the one hand, you end up with maybe a massive redistribution of wealth, but on the other hand, as long as you don't destroy the real investment that you have made, then people will benefit from actually the investment that actually was done.
Yeah, I think that's correct. I think a lot of the destruction comes from credit and leverage. So the dot-com bubble, for example, was not as destructive. There's a lot of wealth redistribution, as you point out, a lot of individual investors entering the market and buying shares of pets.com and so on, and not faring so well in that. But yeah, I agree. I agree with that sentiment. I think where it gets very dangerous is with leverage. And the last thing I would say is it's not a theorem that every incremental dollar of investment is a good dollar spent. So we just happen to be, I think, lucky in the dot-com era that the world continued to need cables, right? And if you go back to the 1920s, electricity, that was a continuing phenomenon. So there's nothing to say that things can't get out of hand and there's going to be dollars that are placed in things that don't matter. I think if you look in the sort of real estate booms in the US, we probably had places where we invested capital that we didn't need to. You know, too many granite countertops in distant suburbs of Las Vegas, right? Where people didn't actually want to live. So that kind of thing, it can happen.
Yeah.
But as it's turned out with many of these bubble episodes, it's turned out to be, some of that, and more of that investment has turned out to be valuable than we thought.
Is there something in this about how the human mind works? Because on the upside, on the uptick, then people seem to be very, very optimistic. Everybody's running in the same direction. And even when people start worrying about things, they still sort of jump on the bandwagon, assuming that they can get out before everybody else. And that seems to be pretty hard to deal with. And how, what's your view on that? Is there an element of, I don't know what to call it, herd behavior, or being overly optimistic?
Yeah, my favorite story in here, I'm sure you're familiar with it, is the one of Isaac Newton and the South Seas bubble. And there's a picture of prices during the South Seas bubble, where essentially he was a very early investor. He made quite a lot of money, and he exited early. And then essentially he looks around, and all of his friends are continuing to make money, and prices are continuing to rise. So he re-enters and then loses everything. And so I think that moment where the skeptics are kind of falling out is a particular herd moment in bubbles. That said, I've spent probably the past 10, 15 years trying to find, for equity market bubbles in particular, that killer indicator of that timing.
Yeah.
And I have not found, in terms of the timing, any particular thing. I'm continuing to work on this question and trying to find different markers. I think it's easier to find markers that say, hey, we're likely in a situation that's bubbly or where there's financial froth. And there's a lot of different variables that you can collect that point to that. But to say it's going to collapse in the next 3 months, 6 months, or whatever, very, very challenging.
But then if you look at these things with hindsight, then it's one thing to look at the equity market, but in many, many instances, particularly if you end up with a serious problem on the macro side,
yeah.
Usually it's not the equity market only, it's also something about credit in the sense that the system gets over-levered in one way or the other. So at least in those instances when you have a very rapid credit expansion in one form or the other with increases in asset prices, then it seems to get more dangerous.
I agree with that. I actually think we're way better at being able to call a credit bubble than a stock market bubble. And it's having to do with the timing and valuations. We have some research, but there are also many people at the BIS and other folks who have worked on this topic for a long time. And essentially what you find is it's what you just said, which is combination of high credit expansion, whether that be household leverage or corporate leverage, combined with asset price growth, is a pretty good predictor of instability of different forms over a 3 to 5 year horizon.
But then when that happens, then what, in your view, what is it that really makes people believe change? Because one day everybody is happy, the next day maybe not, and the day after that, all of a sudden people are kind of unhappy, and then in a bad scenario, many investors say, I'm out of here.
Generally, I mean, I think we're talking here about both in credit situations and then in pure equity situations.
Yes, sure.
In both situations, it's expectations meeting reality, and there are different ways that expectations meet reality. In the credit markets, the cash flows are paying the loans. And at some point, no matter how bullish you are, no matter how willing you are as a banker or an institutional investor rolling over a loan, eventually the rubber hits the road, as they say. You're going to have a spread, and you'll see some failure. You can paper over losses for a long time in the credit markets because you just roll over debt, and as long as there's enough to kind of keep that going, that can. But the weaker players eventually, I think, the fundamentals end up showing in the credit markets. So that's, I think, what happens. You've seen that recently in the United States with some of the private credit issues, which is to say very weak entities borrowing and software, for example, and the underlying cash flows, even with aggressive refinancing, aren't able to sustain the debt loads. And that usually is the beginning of the end.
What you say now is kind of, as a practitioner, music to my ears, in the sense that when you look at these things, when things have started going south, then the scenario tends to change completely from price increases to only a conversation about cash flows.
Right.
And given that the value of something is the present value of its future cash flow, and if there is no cash flow, then people just say, hey, this is not going to work.
Yeah, I mean, one way to think about that in the credit markets is that if you're a credit investor, and let's say you make a 5-year loan, you just care if your loan's going to be paid back.
Yeah.
right? But you start to think about the underlying collateral if you think that you're not going to get paid back, right? So in fact, you can just focus on, today, tomorrow, next year, and hope that it can get rolled over for the short run. But once you start to think about impairment, that's when you do the math on what are the underlying assets worth, what is the, if nobody else is there to lend to this player, what am I on the hook for? And I think that starts to happen. And you're right, it's a total shift in thinking. The credit markets are all about the downside. Equity markets all about the upside.
Yeah, no, okay, that's a nice way of putting it. But also, there's something about, I don't know what to call it, sort of expectations or beliefs, because I remember so well when we go back to 2007, 8, 9, the global financial crisis, which kind of morphed into a euro crisis. And we looked at that in the early days, and then we said, well, this whole business about subprime, that's probably dangerous, but it's tiny. And boy, were we wrong, because it wasn't tiny, because it's kind of morphed into many different crises. And in this corner of the world, all of a sudden we ended up with a crisis in Iceland, and we ended up with a crisis in the Baltic countries. And the sort of the causality from the trigger, let's say, subprime to that wasn't something that we realized at least not in the early days. And that's one example of how quickly these things can turn into something quite different compared to what you thought day one.
Yeah, I don't think we fully understand the link between, let's call it proximate causes and true shifts in cash flow, true realizations, and the shift in beliefs that you're talking about. They seem to happen quickly and all at, right, as Hemingway said, quickly and then all at once, right? But I don't think we know the sequence. For example, a lot of people say that what brought the end to the dot-com bubble in 2000? It was this wave of issuance followed by a lot of these IPO lockups expiring, and there people selling their shares into the market, and there just wasn't enough capital, right? That's a story. Another story is, these companies weren't making any money. And eventually people realize these companies aren't making, so that's actually all happening at once, right? And how do you distinguish between people figuring out that those companies are not making any money and not willing to give that incremental dollar investment that was keeping the whole thing going? I think that's what's very hard, and it's a little bit different probably in every situation, but I think it has elements. Most situations have elements of both of those things.
It's kind of a little bit like when people talk about the foreign exchange market, and suppose for the sake of the argument that you have 500 buyers and 500 sellers, and that means that you have 1,000 different reasons to do things, and then you have an auction, and the price goes up or down, and then you write in the newspaper the next day why it went up or down. Do we really know? No, not really.
Right. Schiller is very, I think, persuasive on this. He talks a lot about narratives and narratives being mostly ex post, because we, as humans, we have a desire to find narratives that rationalize the world we live in. And sometimes those narratives are very persuasive in driving things forward on a forward-looking basis, but sometimes they're just an ex post phenomenon.
Yeah, no, we human beings like stories and storytelling.
Yeah, I think it's most of what we do in economics is tell stories about what we think happened.
Good point. Good point when it comes to that. It struck me when you mentioned the whole issue of credit, that in some sense, credit in terms of evaluations is on the soft side. Do you have strong views on, let's say, accounting rules? Because people usually don't argue about accounting rules until things go wrong. And you have accounting rules and you have auditors. and you have also from time to time evergreening of loans.
Yeah, I don't have a strong view on a particular accounting rules. What I would say is that you discover where the bodies are buried once things go wrong, and sometimes you need to make adjustments in how you are accounting for things. You know, there's a Warren Buffett expression of, you figure out when the tide goes out, you see who's not wearing any pants, right? And I think accounting is a little bit like that. It's a set of rules we use to understand the world of companies and loans around us. And we are always making trade-offs with those rules. You don't want the rules to be too onerous because it's a pain. And at the same time, you want them to be informative. And when people are playing games, you discover and then you adjust the rules, I think, as you go. I'm not sure I see a good way around that problem.
Do you think, is there a major difference between when it comes to the way, let's say, professional investors look at these things when things go wrong and, let's say, the average household, or are we all alike when we change our minds?
I think there's plenty of evidence that individuals and professionals are similar in their underlying behavior. I don't think they have the same level of sophistication. Individual investors, if you were to ask a person on the street, even somebody who has lots of individual stocks that they own, and you said, explain to me why the price, say they own a share of Google.
Yeah.
Why is that share worth $700?
Okay.
I don't think they would be able to do it for you, most people. And I think the professional investor the fundamental investor would probably be able to explain it to you. But beyond that, I think many of the same behaviors come in. People having views about future growth opportunities, behavioral biases, over-optimism in bubbles. I think all of those things are common. For example, I have a paper recently it's called Bubble Beliefs, and it's looking at what the professionals are doing during periods of overvaluation for US stocks. And we looked at the press, and we looked at analysts, and we looked at some other places to try to understand what are people kind of reporting. And what you find is, in general, the professionals are just as optimistic as everyone else. And so, for example, analysts, when you look at these highly valued stocks that subsequently experience a crash, the analysts overall are bullish. They have very high return expectations, and they have very high expectations for growth and fundamentals.
Is that what we call FOMO, fear of missing out? Because you're better off if you're wrong and everybody else is wrong, then it's easier to handle compared to if the market went up and you said that you had to be careful.
We can't distinguish between that and just personal optimism.
Okay.
Right?
Okay.
That's certainly, it would be consistent with FOMO driving things. People talk about FOMO in bubbles, but we can't distinguish that in the data, or perhaps one could, but we haven't looked at that per se. People talk about FOMO as often, when something's in the air, like your taxi driver is talking to you about stocks.
Yes.
I work at the Harvard Business School, and people often say, if you're in the Harvard Business School gym, which is called SHAD, and you hear in the locker room a lot of talk about private equity or whatever the area, that's the time to walk away.
Yeah, in the sense that we are kind of all alike, and you referred earlier to our desire to listen to stories, and I think you have a point when you say that trying to find FOMO looking at statistics is probably very hard, but FOMO would be maybe more of the locker room reference and the storytelling.
Yeah. One other behavioral aspect of bubbles that I've explored in my research is something I call competition neglect.
Okay.
And that is, I think, another sort of underappreciated feature, which is that people don't think about in a boom how the competition is going to play out. And in fact, in most booms, you have incredible levels of competition. Think about what's going on right now with AI. You have OpenAI, you have Microsoft, you have Anthropic, you have a lot of Chinese entities. They're all competing incredibly vigorously to do the same thing. And yet, there are these valuations, huge valuations attached to all of them. You know, in most industries, when you have lots of competition, what happens to profits?
Well, prices are going to go down.
Prices fall,
yeah.
And means low returns on capital, means low fair valuations of these assets, means lower future investment, and so on. And what we find is, in general, that's a general phenomenon of people sort of failing to understand that my investment is going to reduce the returns on your investment. And that's an especially important thing in these booms.
That's actually very similar. Let me bring back this issue of credit that we touched on earlier, because when things go wrong and you can't service your loan, somebody seizes the collateral, let's say a piece of property. And then if you need the money, you sell that piece of property.
Yeah.
And that produces a huge externality in the sense that all of a sudden, everybody can observe that something was booked at 100, but now you can only sell it at 50. And then that means that the whole market kind of is brought down, which is a process which is a bit similar to the one you mentioned when it comes to competition.
Yeah, it's the beginnings of a fire sale, what you're describing.
Correct.
Right. There's a lot of talk about that right now in private credit in the US.
Yes.
And exactly where are the marks? A lot of those loans are being booked at par until they're sold on the secondary market, in which case it becomes unreasonable to hold it at par. If you and I lent to the same software company and I'm holding my loan, and you may have I just sold mine at 80, it sort of becomes untenable for you to market at 100.
Correct.
Unless you have superior terms. And what happens in the bubble, as you know, is that the terms on the loans tend to degrade over time rather than improve. So that ends up being difficult.
But then that's kind of, again, when you're on the cusp of these things and things change and eventually you can't avoid it. You just have to mark down whatever it is that you happen to sit on. And things go in that direction. Now, when it comes to this, then, from reading your part of your research, you seem to come to the conclusion that stock market, as long as it sort of is reasonably isolated, is okay in the sense that people can lose a lot of money, but it's not a major issue in the economy as a whole. But if you combine the stock market with too much credit, then it gets more dangerous.
I think that's correct. If you look at precursors, certainly to financial crises, it's credit conditions combined with asset market conditions that are particularly worrisome. And what I haven't looked at is, if you look at the long history of just equity market booms, what the consequences are of the collapses. So I have certainly anecdotal evidence. If you look at the consequences of the collapse of the dot-com in the late 1990s into the 2000s, I would characterize the collapse as fairly benign for the broader macroeconomy.
Yeah, I think that is sort of the general conclusion in this country as well, because we had our fair share of dot-com bubble here, but in terms of kind of the global economy, it wasn't that things came to a halt.
Right, and so if you look at, on the other hand, if you look in the 1920s, the collapse in 1929, there was a lot of leverage associated with it, but of course there were other things going on as well, so that was not a benign experience. But there aren't that many of these episodes. So I teach at Harvard Business School. We do a lot of case studies. That's mostly how we teach things. And I think a lot of studying bubbles is really getting into the details of the individual cases, because it's not large sample research in the conventional sense. And even if you have lots of bubbles happening in different countries, they tend to be correlated and often reflecting the same underlying forces. Like we had the dot-com bubble was everywhere, right? There were dot-com bubble stocks in Sweden and in Japan and the United States, everywhere. And similarly with the credit episodes. So there's a global aspect, I think, to a lot of these.
But isn't it still so that when you look at these things exposed, you tend to realize that you thought that you were in the stock market, but the money had to come from somewhere. And the money had to come from the credit market in one form or the other, particularly if you make huge investments. And that means that the externality that you end up dealing with, if you look at it from the macro side, comes from the fact that things that you thought were outside the financial sector were actually inside the financial sector.
I agree with that, but if in the 1990s, most of that money was from the equity markets, right? But if you have other episodes, I agree. If you have hidden credit exposure, that's where danger lies. I think we don't know quite as much about how that's working for the current crop of AI companies. A lot of the AI investment is being fueled by retained earnings from these entities' existing businesses. Like if you look at Microsoft, Microsoft makes a ton of money selling Microsoft Office, and rather than plowing that back into dividends or repurchases, that's now going into AI infrastructure, right? Google makes a lot of money on search. That's now going into AI infrastructure and data centers and so on. So you could call that kind of leverage in some sense, because relative to the counterfactual of returning that capital, but it's not leverage in the traditional sense.
No, in this, because being a bit soft on definitions, it's your money. It's not somebody else's money.
Yeah, it's your money, and you're not borrowing it.
Correct.
You're not creating a new structure that you can default on. So you could say that's equity financed.
Yeah.
Right? I think it would probably be the natural way to describe it, as being essentially equity financed. OpenAI is a little different. They seem to be going to outside capital to raise that money, right? Because they are raising a lot of that with deals with their partners. And so maybe that's a form of leverage. There's a lot of talk in the press about that. I don't fully understand the form of that leverage and whether that leverage is going to be quite as dangerous as the leverage we were talking about in 2006, 2007, for example. But it might be. So if there's a collapse in what's happening in AI, in these AI stocks, will there be some sort of cascading effect across these different entities that have points of connection through these deals? Perhaps.
With all the kind of business school cases that you have been through and the research that you have done, is it fair to say that very often, particularly when you look at this issue from the credit side, because that's when it gets dangerous for the economy as a whole, that we always tend to be taken by surprise when it comes to realizing that the system was over-levered, but we didn't fully understand ex ante what was going on. Well, ex post, it's of course easy, because then you can see what actually happened.
I think the fact that if you look at the records, for example, of what people were talking about in the Fed meetings, they've published the minutes, you can tell there probably wasn't enough discussion about financial vulnerability going into 05, 06, 07. So I agree with what you're saying. I mean, I would hope this is the phenomenon that people study and we got more of a historical record and we're trying to do better. It's a little bit like developing medicine. When you see lots of people falling ill from one particular thing, you try to develop something so that that can be milder in the next incident. But that's, at this point, is really just a hope, not a strategy.
I find that first very sort of positive, but at the same time, as a practitioner, a very difficult issue, because what you get into is this whole issue of policy design. And somehow, when it comes to particularly how inflation targeting and the theory around inflation targeting developed in the late 1990s and early 2000s, monetary policy was kind of separated from everything else. And then, despite the fact that we do know that if interest rates are low, people borrow, and they sometimes borrow too much. And we have had a hard time finding the proper combination of dealing with monetary policy and financial stability. And you made the reference to minutes, and when you read the minutes, you sort of see that it's hard to discuss monetary policy and financial stability at the same time.
I agree with that. There are some places that seem to do a bit more of it, like in Singapore. They are willing to do what people have called, economists have called macroprudential policy. But for large economies, I agree it's trickier exercise, partly because what you're really doing, unlike the output inflation, which feels a little bit more linear in its trade-off, when you're thinking about financial stability isn't really a problem until things blow up. And while the party's going, it's fantastic for everyone. You've got GDP growth, everybody's making a lot of money. What's not to like? And then you're sort of guarding against this destruction that happens, and how aggressively do you lean against that possibility? What if the destruction is mild? How do you think about that? So I think all of those are great questions, and I think that's contributed to the reluctance to incorporate these things formally. I think you can bring it into this output inflation language, because you can say, if the probability of a crisis goes from, say, 10% to 30%, and you know that the cumulative effect on, say, GDP growth is going to be X, well, you can say, well, that's a 20% times X, and I can incorporate that into my output inflation discussion in the same way that I would treat that normally. So I think you can do it. I haven't seen very much of that, but I think that's the next generation of people will be trying to figure out how to do that carefully.
Well, I have kind of a personal experience when it comes to this, because it just so happened way back, could have been 2006, maybe 2007, and I was at Jackson Hole talking about the housing market. And I argued that you really have to worry about the housing market, and it's the job of the central bank from time to time to say no. And
how was that received?
I only got support from one individual in the room, and that was Stanley Fischer. Because my argument was that it's not easy to put the pieces back together.
Yeah.
And so you really need to think about this. But during my entire tenure, this has sort of come back time and time and time again. And it's very difficult to deal with. One sort of theoretical step forward is the IMF version of what they call growth at risk, which is basically a GDP fan chart coming from the financial sector.
Yeah, I'm a big fan of this work. Tobias Adrian.
Correct.
Right, yes, absolutely. Sounds like you were ahead of your time.
yeah, but it's still, when you refer to minutes, when you read about these things in minutes, it's incredibly hard to sort of translate what you find or do not find in minutes, and particularly if you argue about financial stability and to turn that into actual decisions when you talk about monetary policy.
Yeah.
So
monetary policy is hard anyway.
Yes.
So it's just another hard thing that you're adding to it.
Yeah, yeah. Do you have a strong view on that? Because one way of thinking about it is to say the following, that these policy choices are essentially about making it more costly to borrow.
Yeah.
And you can do that by raising the policy rate. You can do various, what you call nowadays, macroprudential measures, making it more costly to borrow because you have loan-to-value restrictions or amortization requirements or things like that. Or you can basically demand that the banks increase capital, let's say, in one form or the other. Do you have a strong view on how to find the proper policy combination?
I don't have a strong view on that. I think it's probably easier from a political perspective if you do most of it within the output inflation trade-off and use your conventional instruments rather than adding additional instruments like trying to change amortization schedules or loan-to-value requirements and so on. It feels like the central bank at that point intervening in more aspects of the economy, which, I think it all amounts to the same thing, but it's easier if the central bank, quote, stays in their lane. So my instinct would be to try to do things at the margin with the policy rate. Now, having said that, my understanding is there are places like in Singapore where they use other instruments. For example, in Singapore, there are strong rules around foreigners buying in the real estate markets. And those rules have evolved over time, and they evolve in response to price changes, right? So it's not to say that those things can't be effective, but I think in a world where people are asking lots of questions about the power of the central bank, maintaining a fairly narrow set of instruments, I think, is in the central bank's interest. Now, there's a kind of related question, which is, I also don't know the right answer to, but how do you think about if things look a little bit frothy, you probably want to lean against the wind a bit. But once things look really dangerous, what do you want to do? There, it's harder. I think there you have to pay close attention to your banks and capitalization and so on. And you have to worry that leaning against the wind when things are about to fall apart, you're actually going to make things worse. So I think that's another difficult trade-off.
I mean, let me sort of comment on that. Part of it is about timing, because leaning against the wind is really about starting to lean before it really gets windy.
Yes.
But once the storm hits you, then to your point, then if you lean too much, the system blows up. And that's, of course, a very, very tricky trade-off. I think that this country is a good example, because after the crisis in the 90s, the rates started going up, because rates started going up in the US, and with free capital flows, we are affected by that. And then we knew that the system wasn't okay. So then the issue was, how far can you raise the policy rate without the system falling apart again? And now this latest episode after the pandemic is sort of similar in the sense that most of the mortgages in this country are variable rate mortgages. And then when inflation hits 10%, how far should you go in order to deal with inflation? And if you overdo it, then the housing market is going to fall apart. So,
yeah,
how do you deal with that?
It's hard. That's why they have talented people running the central bank to figure out these important tasks.
So that's kind of what we're talking about. Have you reflected on also you sort of said, you talked about the policy setup and what the central bank should do and what others should do, because clearly in different parts of the world, and you referred to Singapore, it's also about the institutional setup, in the sense that who has been assigned to do what. And how do you coordinate that if you have many different authorities who are supposed to deal with these issues?
Yeah, I think there's this is a topic that I haven't studied myself, but I think is a very important one. It's an important one in the United States right now. If you think about, for example, should the Federal Reserve do bank regulation?
Mm-hmm.
There's some synergies, certainly, and in a crisis, it's extremely helpful. On the other hand, having a relatively narrow mandate, there's some arguments for that as well. So, yeah, I mean, it's like a lot of design questions. There are trade-offs involved. I think, absent the politics, in general, you probably want more centralization. But given the politics, that sort of pushes you in the direction of, keeping the different entities in their own lane, and also having political accountability for as many institutions as possible. And maybe if the central bank is sort of the freest from political accountability on a day-to-day basis, making sure that the mandate for the central bank is still relatively narrow.
My experience of reflection on this is that regardless of where, let's say, supervision is located, or not monetary policy, keeping track of what's going on in the financial sector, if you end up with a problem and supervision is with the central bank, you move it out. And if supervision is outside the central bank and you end up with a problem, you move it in. So I don't have a perfect answer.
Well, this is a little bit like your accounting question earlier.
Yeah.
I think you're always responding to the last crisis.
Mm-hmm.
And your policy, the design of the institutions will mirror what you perceive as one of the institutional failures in the last time you dealt with it.
Now, since it's time to round up, and you have touched on AI earlier, and you have also touched on the various conversations in the U.S. about private credit, do you have a view on where we're heading? Is it a good benign scenario, or are we heading into problems?
I think right now, if we were to have a quote AI collapse, I think it would be relatively benign from let's call it a bubble collapse scenario.
Yeah.
I think, as we were talking about earlier, it's mostly been funded with equity, essentially mostly through the earnings of these very profitable companies. And there are some exceptions, and so, for example, there's a lot of venture capital money that would be lost and so on, but I wouldn't be particularly worried about it. However, we are moving in a direction with many of these companies going public, and I would expect to see more debt financing going into these companies over the next year or two. It's a huge capital gap. We're talking about, I believe, $600 billion, I may have the number wrong, this year, looking at $700 billion of CapEx next year. That's, as you mentioned earlier, that money needs to come from somewhere. And even though these companies are profitable, the data centers are going to require capital, and anything in real estate typically ends up coming from some form of credit. So I think we're on a path to more danger, and so it's really a question of how long this keeps going.
Well, on that note, then, I really liked your concept of red zone, because we have touched on the combination of financial stability and monetary policy. And I really wish you success when it comes to further work on the red zone, because that is actually, at least in my view, a useful concept when you are a decision maker, because it gives you a hook to hang things on when it is time to say no.
Yeah, thank you. Maybe for your audience, I can explain what the red zone is. The red zone is based on some research that I did with Jacob Sorensen and Andre Schleifer and Sam Hansen, and it was really a simple indicator variable that turned red when two things happened. One, you had massive credit expansion, and two, that happened at the same time as you had asset price expansion. So things that you already said many times in our conversation. And we developed a few thresholds for when that kicked in. And what we showed is that the probability of a crisis over the next 3 years goes up from about 8% unconditionally to about 40%. So that's the sense in which you're in a red area where you would be concerned.
But it's a helpful concept, because if you are a decision maker and if you publish minutes, you always get criticized when it only in the minutes says "because I think so."
Right.
and given the way the human mind works, we like numbers.
Yeah.
And your research makes it possible to put a number on these things.
Well, you're kind to say so. Thank you.
Thank you so much for a very fascinating conversation.
Thanks very much.